Hello, hey guys. So my name is Romit Chandani, and I am a tutor, actuarial tutor from India. And today we'll be discussing subject CD5 contingencies. Without further ado, I would start talking about the subject. We'll be dealing with life insurance mathematics here. So what we'll be studying is life insurance mathematics. So we'll be talking about life insurance math here, and that is our objective. So what do I include in this? Okay, so I'm gonna take an overview of the syllabus first. So that is the first thing we do here. That is an overview of the subject. Okay, so what are we trying to do here as an actuary? What are we trying to do? That is our first question. What we are trying to do is, suppose I am an actuary appointed by a life insurance company, and what a life insurance company does is a very simple kind of a thing. Here is a life insurance company, and here are its policy holders. Okay, so there is an insurance contract, life insurance contract. Insurance contract taking place between the life insurance company and the policy holder. So what the promise here is that if this policy holder he dies during a particular term or survives till the end of the term, typically this is called as an assurance element, and this is called as an endowment element. Okay, so there are two types of life assurance contracts: assurance and endowments. Okay, talking about this, there is a contract between the life insurance company and the policy holder that if a policy holder dies during the term, the life insurance company will be paying him a certain amount that is called as the claim amount. Okay, and in exchange of covering this risk for the policy holder pays the company a premium amount. This premium might be monthly, it might be annual, or it might be just one sum that is called as a single premium. So this kind of a contract takes place between the life insurance companies and the policy holder. So where do we come in? Where do actuaries come in this process? Actuaries are appointed by the life insurance company to tell them what is the amount of premium that they should be collecting from the policy holder for taking this risk of theirs. So the life insurance company is undertaking a certain risk of the policy holder, that is, they are going to be paying them an amount when they die or if they survive to the end of a term. This amount is called as the claim amount, and they will be collecting a premium which is calculated by the actuary based on, they do a certain mathematics based on certain probabilities, and we'll be discussing all that in the subject. But that is what we do. We calculate the premium. This is called as the pricing of an insurance contract. That is our first job, pricing. Okay. Second job that we do is reserving. What does reserving mean? It will come in detail eventually in the subject, but for now I want you to know that what happens is, we are paying premiums, we are paying claims to people who are dying, right? So let's say a person takes out a policy. He is 20 years old. Okay, 20 years old guy taking a policy, and the policy states that if the policy holder dies within let's say 40 years, within the next 40 years, till he is 60, till he reaches 60 years of age, if the policy holder dies before this age, the insurance company is liable to pay him an amount of let's say rupees 2 no, not rupees, pounds, 2 billion. He is a rich guy. Okay, so the insurance company is telling him that we'll be paying you 2 billion pounds if you die within the next 40 years. Now the chances, if I talk about chances here, we'll be coming to this in detail eventually, but if I talk to you about chances right now, so chances of the guy dying at the age of 20, or at the age of let's say 30, or at the age of 40, or at the age of 50 or 60, so these are all the possibilities that can happen. He can die in any decade. Okay, let's say these are the 5 possibilities that can happen. Chances of this guy dying at these different ages would be different. It would be more probable for him to die at age 30, less likely at 20, even more likely at 40, much more likely at 50, and at 60 it is quite more probable that he will die. So the risk for the insurance company keeps on increasing, but in exchange the guy pays only level premiums to the company. Level premiums, that is, the premiums are full in amount, but the risk, the outflow, the liability of the company will keep on increasing. So wouldn't it make sense for the company to make a reserve of these premiums? The company will keep these premiums with themselves so that in case a claim arises on a bunch of policies, they can pay it easily. So this reserving is a part of our process. We'll be discussing it in detail eventually. And the last job that we do as an actuary that is covered in this beautiful subject is wait. The third thing that we do is, what we do here is profit testing. This means that what amount of profit a company expects to earn on a certain number of policies so that it can survive. And that is how we, on the basis of this profit testing procedure, so that we get a certain amount of profit, we decide the premium of the policy. So this is first of all we'll be pricing the policies without profit, and then we'll be taking more realistic estimates incorporating the profit. So this is all about the subject. Now if I go to the syllabus, if I want, I'll just I'll make a new page for this. Okay, add a page. I want a new page. Okay, right. Why isn't this black? Okay, I'll write on white. Okay, fine. So yeah, so if I discuss the syllabus with you guys, let's start. Okay, we have got chapter 1, 2 and 3, which are the basics. Here we'll be discussing the various types of contracts, 1, 2, 3 and even 4. These are the basics. We'll be discussing life insurance contracts, what is their nature, what kind of symbols we'll be using to price them, to deal with them, and what our methods would be, what kind of tools we'll be using. So there'll be life insurance contracts, there'll be life annuity contracts, because payments can be continuous too, one after other. I can make let's say 20 payments to a guy who survives for a certain term. So I can make a payment of 1 lakh to him each year, right? So there are life annuity contracts. And then we'll be discussing the life table in the third chapter, where we'll be discussing the probabilities of whether a life survives or dies and what are the chances. So we'll be making a table and we'll be discussing it through graphs. Very interesting things here. If we get to chapter 5, 6 and 7, here we will be discussing premiums, the calculation of premiums and reserves. Okay, so this is what we'll be discussing, and after this, if when we are done with the 5, 6 and 7, then we'll get to chapter 8 and 9. Okay, chapter 8 and 9 basically cover joint lives. Basically what will happen here is that instead of having one life to whom we have issued a policy, we'll be dealing with policies with more than one people, basically two people. So two people, two related parties would be here, and the contracts would be such that a certain amount of money is paid to life 1 when life 2 dies. So when life 2 is dead, life 1 will be getting a payment. Let's say, for example, there's a couple, a husband and a wife. So when the husband dies, the wife gets a payment. So this is the kind of policy, because in many of the countries, ladies do not earn. So just to give them some sort of financial security, these kinds of policies were designed. And there can be business partners who can take these policies, there can be brothers, there can be children who would be the beneficiary in case of their parents die. So these kinds of policies would be discussed in this section. If I talk about chapter 10, this comprises of competing risks. So far we have just talked about the risk of death. Now there will be more risks to a particular population. If I talk about a person, he can get sick, they can get let's say they can exit a population by getting married, they can retire, a couple of other things that can happen to a person. Okay, and the probability of a sick person dying is different from that of a healthy person dying. And same goes for married people. Married people are less likely to die as compared to single people or bachelors. I'll get to this later. I'll tell you why that happens. That is a very interesting fact, that it has been observed that married people are much less likely to die as compared to single people. Okay, so that is something very interesting. We'll get to that. After that, these things can happen to people. So these risks exist, okay, in a population, and they compete to kick out a healthy population, a healthy person out of the population. So these risks basically compete with each other. So that's why they are called as competing risks. And this chapter requires a certain background from subject CD4, which even if you haven't passed, I will be discussing the basics which are required from CD4 to here, so that you do not struggle with this very interesting chapter. Chapter 11 deals with the pension funds. I did not ever like this topic. This is something out of the line which is formed here. These all chapters, they seem to belong here. This chapter is totally different and unrelated to all the above chapters, although it has some links to competing risks. But then it is a very weird chapter, but it is easy, so we'll be discussing it in detail. This is something students struggle with, so this is some struggle, there is some sadness about it. Okay, and then we get back to the normal contracts we had been discussing, since we had last left them in chapter 5, 6 and 7. Then we had started with the joint life, so we'll get to single life contracts again in chapter number 12 and 13, where we'll be doing profit testing and reserving for these contracts. So we'll be doing profit testing and reserving all over again. So these two chapters, they're very interesting, loads of calculation, loads of tables, and you will need to use your intuitive aptitude. So there's a lot of understanding and everything with this chapter. And the last chapter, chapter 14, is mortality, selection, and well it is and I don't and there are summary measures. Okay, so this is the last chapter, mortality, selection. Here this is a theoretical chapter, theory. We'll be discussing some theory related to life insurance and pension contracts, and it's a very scoring chapter, and it is interesting and not boring at all, and you don't need to learn the theory. That is the beauty of actuarial science. You just need to intuitive. So yeah guys, that was all about our curriculum. Now I will be discussing something which is really important, that is links of CD5 to other CD subjects. So if I talk about CD5 in general, how is it related to CD1, CD3, and what kind of a background you need in this subject, I'll tell you a simple formula. Okay, we are actuaries, mathematics people, we understand formulas. CD1 plus CD3 is simply equal to CD5. Now you'll ask me how is CD1 and CD3 equal to CD5 added together. I'll tell you something very simple. What CD1 dealt with was basically interest. In general, we dealt with discounting, and accumulation. CD3 dealt with probabilities. That is, in general, we dealt with expectations and variances. In CD5, we are discussing life insurance mathematics. Here we'll be pricing and reserving insurance contracts. Now, if you think about an insurance contract, there is a life. Let's talk about this in a bit detail. Okay, yeah. So if I talk about a life insurance contract, as I did earlier, there is a life insurance company and there is a policy holder, and the life insurance company pays to the policy holder a claim amount. This is uncertain, that is, it can be payable 1 year later, it might be payable 2 years later, it might be payable 3 years hence, and it might not be payable at all if there is, let's say, there is an assurance contract and the policy holder survives till the end of the term. So then there is no liability, and in exchange the policy holder pays premiums to the company, and if these are generally monthly or annual premiums, and these might also be uncertain, because for example, if the policy holder dies after 1 year in a 5-year contract, then he'll only be paying 1/5 of the total premium. So there is an element of uncertainty attached to it. Also, these amounts, they will be received by the insurance company, these premiums, they'll be receivable by the insurance company in the future, and claims will be payable in the future. These are inflows for the companies and these are outflows. Okay, so they are future payments which need discounting, hence we need subject CD1. So as this involves discounting and as they involve an element of uncertainty, that is probabilities, we need subject CD1 and we need subject CD3. So if I talk about subject CD5, it is a combination of these two subjects. Okay, that is why I say CD5 is equal to CD1 plus CD3. But it is not necessary that you should have necessarily cleared this subject in advance before you appear for CD5, because these things, probabilities, expectations and uncertainties, you must have learned them at some school level. Okay, you must have learned them in your school while you were graduating there. So you must have learned these topics, and these are simple topics, so we do not need the CD3 subject in very detail. If you have passed CD1, you can appear for CD5 and it won't be a problem for you at all. One more knowledge CD5 requires is from subject CD4, as I told you about chapter 10, competing risks. And that is because the thing is that with life insurance contracts, there is a thing called as force of mortality. Okay, force of mortality is similar to subject CD1's force of interest. It is denoted by mu, force of mortality. We'll be discussing this in detail. Okay, so this is something which is a CD4 thing. Okay, but again, studying CD4 is not necessary. I'll give you all the background that is needed for you to study CD5. Okay, so you can be rest assured that all you need is to have cleared or studied subject CD1. Okay, so here that is the deal. Let's see. Okay, so what will we be talking about in this subject CD5? You must remember from subject CD1 that we discussed something called as an equation of value there. The equation of value in subject CD1 said that the present value of outflows must be equal to the present value of inflows, and this is what we followed in subject CD1. What subject CD5 says is something very similar, but with probabilities attached to these present values. So subject CD5 says that expected present value of outflows must be equal to expected present values of inflows. How do we calculate these expected present values is a subject of interest. So I will be briefing you about it right now. See, if I try to calculate present values, what do? I just take the amounts, whatever amounts I'll be receiving in the future, and I multiply it by the discounting factor. Okay, and I multiply these two things and I add all the amounts and I get the present value of outflows or inflows, same thing. But here the thing is that there are probabilities attached to these things. Okay, so since there are probabilities attached to these things and these are uncertain quantities, we will also be multiplying probabilities of these payments. This is something like you can think of it as calculating the mean. Okay, the formula for mean or expected value, expectation, which we call expectation, you must have learned this in subject CD3, is sum of x into this is for a discrete series, x into probability of x summed over all the values of x. Okay, so this is your mean. Similarly, as I'm calculating the expected present value here, the formula changes just a bit. It would be sum into amount, that is x, into the discounting factor, which I need to multiply because these are future amounts, into probability of x summed over all the values of x. So this is how it all functions, and that is how CD5 is related to subject CD1 and CD3. And so yeah guys, this was all for the trial, and I hope you enjoyed the introduction to the subject. I will be making a full course on subject CD5 on teachable.com. I will share the link to that in it's just right below this video. I hope you liked it, and like, comment, subscribe, like all the YouTubers say, and tell your friends about me. And if I hope you I don't know, buy my course. Thank you, and this was Romit, the actuarial guy.